Understanding how a deal with ESO gives you free leverage and diversification sounds complicated, but it's not. You may think since ESO takes a portion of your options, you'd be better off exercising on your own if you can afford it. But this isn't always true. A deal with ESO can be advantageous even if you can afford to exercise on your own. Suppose your employee stock option grant consists of 100,000 shares with an exercise price of $1 per share, and the current fair market value is $2.50, translating to 50 cents per share in taxes. You need $150,000 to exercise your stock options and cover taxes. That's a big number, and even if you can afford it, ESO can help. Let's explore the differences between exercising with your own money and letting ESO invest for you to see how each option plays out in the long run. If you exercise on your own, you pay $150,000 of your money to exercise and cover taxes and get 100% of the stock's value on exit. However, you also face all the risk and your money is now tied up in your company's stock. On the other hand, if ESO invests for you, ESO pays $150,000 to exercise and cover taxes, and you pay $0 up front. Say ESO takes 35%. You get 65% of the stock's value at exit. Remember, this loan is non-recourse, so ESO takes all the risk if the company fails. Of course, alongside your ESO deal, you now have $150,000 to invest as you please. You can make a conservative investment, like paying down your mortgage, take a moderate risk with a diversified portfolio, or take a more aggressive approach by investing in Bitcoin or crowdfunding startups. Let's say you invest $150,000 to reduce your 3% mortgage. You wouldn't be able to if you exercised on your own. Now, let's pretend the company does great and goes through a liquidity event such as an IPO or an M&A. In both cases, you end up happy because you have made more money. If you invested on your own, you retain 100% of the earnings. If you let ESO invest for you, ESO takes a portion of the return on the investment. But you've also invested your freed up capital into a smart investment that made you additional income. It all comes down to whether the return on the extra $150,000 investment you make is worth more than 35% of the earnings from your options. Remember, ESO takes all the risk, so you avoid tying up your money into a risky asset and still maintain a future upside. Overall, your circumstances and confidence in the company would have to be above average to justify carrying the additional personal risk. An advance from ESO to exercise your options can provide you with significant upside and minimal risk.